Investing is one of the most powerful tools you have for building real wealth. But let's be honest, it comes with a lot of moving parts, and that complexity is exactly where people get stuck or even make expensive mistakes. So in today's video, I'm going to cut through the noise and answer the investment questions that I get asked most often, from how to build a portfolio to fees and taxes to the big one, whether you can do it yourself or if you need an advisor. My name is Quentin Chambers. I'm a financial planner and portfolio manager. I've been doing this work for over a decade, and I've built hundreds of financial plans for Canadians. And over that time, one thing to me is clear. People just like you are leaving real money on the table. And on this channel, I show you how to put that right back in your pocket. How do I build an investment portfolio that fits my risk tolerance and my goals? Now, this is the foundation, and it starts by understanding your capacity for investing today, as well as what your goals are for tomorrow. It really begins with your risk tolerance, and that's understanding how you feel when the markets drop. Now, if you've never invested before, you might not know. You might not understand how it actually feels emotionally when the markets go through a major swing. Your comfort level is going to be what drives your asset allocation, and your asset allocation is the mix of stocks, bonds, and other investments that you hold. And that tolerance is going to shift with your age, your income, and your financial obligations. So it's very personal. And from there, you want to set clear goals. Are you saving for retirement, a home, your kids' education? That timeline for each goal is going to shape how aggressive you can invest. A goal that's 30 years out can handle far more ups and downs than the one that's 3 years out. Then we want to think about diversification. Now, we've all heard the term, don't put all your eggs in one basket. And essentially what that means in the world of investing is you don't want to put all your money in one company, sector, or even geography. So you don't want to put all your money in Apple, even if you think Apple's a good company, because you don't know what's going to happen with it tomorrow. You don't want to put it in one sector, like technology, because again, technology is booming, but you don't know where it's going to be 3 or even 5 years from now. Or geographies. Again, the classic example is the United States. The United States has been a great performing country, but again, we don't know what's going to happen with it tomorrow. A young investor with a high risk tolerance might lean heavily into just equities or stocks, while someone nearing retirement might shift towards a more conservative bond-heavy mix. That's why it's so important to review your asset allocation and make sure it actually supports your goals. Why does diversification matter so much? Diversification is how you manage risk while still making sure that your money is growing. Now, diversification does 3 big things for you. First, it's going to help you reduce risk. By spreading your money across different asset classes or companies, sectors, or even parts of the world, you soften the blow when any single investment performs poorly. That protection really shows its value during a downturn. Second, it's going to help smooth out volatility. Now, volatility is just the ups and downs that happen on any day, week, month, or year. When you hold a genuine mix, they do not move all together. So stocks might be following a slump, while bonds might be holding steady or even rising. That balance makes the whole ride much less jarring. And then third, it helps you maximize opportunities. Diversification is not just playing defense. It actually lets you capture growth across a wide range of different companies, sectors, or even geographies, instead of betting everything on just one. You're balancing risk and return rather than just gambling on a single outcome. How often should I review and rebalance my investments? The process of having regular check-ins are going to be what keeps your portfolio aligned with your goals over time. Here's a simple rhythm to follow. At minimum, do an annual review. Once a year, check whether your current allocation, meaning your mix of stocks and bonds, still matches your target and adjust if it's drifted. Beyond that, let your major life changes be the trigger for the review. Marriage, buying a home, a job change, any of these can shift your financial picture enough that a portfolio should be re-examined. Now, there's a specific mechanic that makes all of this work, and it's called rebalancing. Rebalancing is a process that means buying or selling to bring your portfolio back to its intended asset allocation. Say stocks have had a great year and run up to 70% of your portfolio instead of the target 60. Rebalancing means trimming some of the winners and topping up your bonds or other assets to make sure that it's even. It quietly enforces discipline of selling high and buying low, and depending on market conditions, you might rebalance more often, maybe quarterly or even when your allocation drifts past a set threshold. The key is having rules and sticking to it rather than reacting emotionally. How do fees and taxes affect my investments? More than almost anything else, and this is where a lot of returns quietly disappear. Let's break it down one by one. First, fees. Management fees, fund expense ratios, trading commissions, they all chip away at your returns over time. And here's the part that shocks people. A 1% annual fee sounds tiny, but over a few decades, it can cost you tens and sometimes hundreds of thousands of dollars in growth because of compounding working against you. Favoring low-cost options like ETFs and index funds is one of the simplest ways to keep more of your own money. Second is going to be taxes, whether it's interest income, dividends, or capital gains. Taxes eat into your net returns. So it's making sure that you're using tax advantage accounts like your TFSA or RSP to tax shelter or defer taxes. And in your non-registered accounts, make sure you're leaning on tax efficient strategies like holding dividend paying Canadian stocks to benefit from the dividend tax credit or harvesting capital losses to offset any gains. Small moves here compound into real money over a lifetime. Can't I just manage my investments myself? Do I really need an advisor? Now, I love this question, so let me do my best to answer this question without bias, even for the parts that aren't in my favor. Yes, you can absolutely manage your own investments, but let me start where an advisor tends to earn their keep. First is going to be time and expertise. Managing a portfolio well takes ongoing research, monitoring, and a real grasp of what's going on in the markets. An advisor that handles that for you frees up time so that you can do what you do best, as well as tying their specialized knowledge to your broader financial picture. Which leads me to the second point, and that's customized planning. A good advisor tailors everything to your specific goals, risk tolerance, and overall financial situation. That matters even more when your life gets complex, especially if you're dealing with estate planning or tax optimization. But here's the one I would argue that matters most, and that's behavioral coaching. The single best advantage of a good advisor shows up when the moments are the most scary. When markets are falling and every instinct in you is screaming to sell, an advisor helps you avoid that emotional decision that wrecks long-term returns. Staying in your seat at the bottom is worth more than almost any other stock pick, and it's the hardest thing to do alone. So in practice, a great advisor does comprehensive and integrated planning, which is far more than just picking investments. They tie together your retirement, your risk management, your taxes, your estate into one cohesive plan where every piece supports the others. When it comes down to managing your own investments, here's my honest take. If you're generally knowledgeable and you're interested about investing and you're disciplined enough to have a plan and then stick to the plan, especially when markets get ugly, and you have the time to do the ongoing research, then managing your own portfolio can absolutely work for you. The DIY path can be the right one if those three things are true, but the key word there is discipline, because knowledge is not the hard part. Behavior is. Most people who struggle on their own do not fail because they picked the wrong investment. They fail because they panicked at the wrong moment. So be honest with yourself about that. And if you would rather have a well-rounded, lower stress approach to your long-term growth, that's exactly where working with an advisor adds value. So here's the bottom line. Investment management is not a one-time decision. It's a continuous process. It starts with a thoughtful portfolio construction, then regular reviews, and then having a clear understanding of how fees, taxes, and market dynamics shape your returns. Whether you go it alone or if you're working with a professional, the one thing that matters most is this. Your strategy has to match your needs and your goals. If you want help building an investment portfolio that meets your specific needs and goals, or if you just want a second set of eyes on what you already have, the link to book a free introduction meeting is in the description. As always, make sure you're leaving a like, subscribe so more videos just like this end up your newsfeed. Until the next one, take care.